Hey, good day, everybody. Welcome to the Deal Scout. On today's show, we're going to have a conversation with my friend Karen, who was referred by another friend, Bree. Just an incredible group of people who really love and support businesses as they grow and scale. And one of Karen's specialty is the ability to look into the C-suite, right? So that's the upper tier of a business of a management. You have chief executive, this and that. And Karen has provided advisory roles and support for these groups. And so she has some wisdom, knowledge, experience to share with you fellow C-suiters out there. So with that, Karen, welcome to the show.
Thank you, Josh. I really appreciate you having me on the Deal Maker podcast and just totally honored to be speaking with you and excited about what I'll learn from our discussion today. So thank you again.
Yeah, you're welcome. So Karen, as a fractional CEO, as an interim CEO, as a replacement CEO, sometimes you get put into opportunities where you help rescue a company or maybe, come alongside another CEO. What does the role of CEO look like from the organizations and experiences that you've had in the past?
Oh, that's a really good question, Josh. I think when I look at organizations, a few things. One is the initial discussion, usually with a partner or a hiring manager. They sometimes they don't really understand the whole story. So you have to kind of listen for keywords and key phrases and to try and distinguish what really is the underlying cause. I was recently talking to a packaging company locally, and they kept saying about, the accountant really needs to know GAAP and really needs to be able to talk to auditors. And as I was talking with them, finally said, did you have some trouble with your audit this year? And then that's where it came out that there were challenges. I think in terms of as we look at that C-suite, and we need to know that going into it, we may not have all the information. So then we need to use listening skills to think, what are some of the key factors to running the business? Cash, right? Cash is king. We've heard that forever. So what can we learn about the cash flow management and the liquidity so that we can optimize that as quick as possible? Um, we want to make sure that we can understand where our debt restructure is, where our financing is. And a lot of times when you're coming into an organization, people don't have all those ready answers. For a variety of reasons, they may not have been addressed. That's why you're into this organization. What are some costs before you go down the cost reduction? You want to know, what's the story behind cost reductions or efficiency improvements? Where can we go? I always hate to pull the cost lever too fast because I always tell people, you have three levers: your volume, your rate, and your cost. And it, people, it's easy to lean on cost. Um, and I think it's one of the three levers that you need to pull, and it is a delicate balance on pulling them all. So when I look at an organization and go into the organization, again, I'm wanting to understand the balance sheet, so the cash flow, the debt, to understand that liability section of the balance sheet, and then also understand from an ops perspective, where is the low hanging fruit so we can start to get some real synergies quickly.
Yeah.
So those are things I go in looking for.
Yeah, I like that. Now, I love how this came from experience, it sounds like there's a few levers you could pull that can
Mm-hmm.
impact the business. So a business, might be struggling and they might bring in an interim CEO, or maybe
Mm-hmm.
if there was some type of acquisition or transition that happens. And you talk about three levers that could happen: volume, rate, or cost. And you said be careful about pulling the cost lever too quickly or too hard. Cost is the easiest thing to look at and start making chops and cuts. What are some
Yeah.
of the side effects of pulling that cost lever too quickly or too hard?
Superstore. When I walked into Superstore, they had been leaning very heavily on cutting costs, especially around the shared services function. As a result, what they ended up with was a dysfunctional support organization. It didn't have enough people. The senior management wasn't able, and the board, they weren't able to get the reporting, that information they needed out of the system. What they were able to get, they had questions about it. So if you're cutting too hard, too deep in that organization, you start to sacrifice things like your data governance. And what does private equity look for, right? They're wanting data. What does a private owner, a founder want? They want data. What's driving their business? What story can you tell? And if you can't get to that data and you can't get to it quickly, that compromises everything. So even though it's easy to say, look around and say, well, we need to cut all these positions, you really need to think more about, always, one of the first projects I always do in an organization is step back and look, just kind of study what skills, what functions do I need? What skill sets do I need in those functions? And then what skill sets do I have in my portfolio there, my people, and how do they fit into these functions? And if I start at that top-down holistic approach, sometimes I end up with people in different positions because of the skill set, because I'm looking to hire certain functions. But I'm able to then bring it so that sometimes I can work within that framework of that heavily cut structure. That's what I did at SSI. I was able to move some positions around and stem the blood flow, stem the data issues I had, and manage and actually optimize the labor. But I can't do that all the time. And we've seen a lot of companies where they'll quickly cut, and then they have to hire back shortly. Well, they're going to have the hiring cost, right? And that's going to be cost them more, not just in terms of the labor, because the market is moving forward faster than they would with raises, but also you have the onboarding and that productivity loss. So there's just so many costs you're able to avoid if you're able to manage your cost reductions systematically and thoughtfully.
Yeah. Now, when it comes to rate and volume, if we're looking at, some industries, that's very tough to increase your rate, right? Like there's
Mm-hmm,
high competition, and that might not be a strong factor. So the other, alternative is maybe volume and cost, right?
mm-hmm.
What are some things that you've seen as a, CEO and in the C-suite on ways to boost volume? Like, let's just say sales is the way we're going to get out of
Mm-hmm.
it. What are your thoughts?
Yeah, so Superstores is a great example. When I worked at Pepsi, we did a lot of this with food service. But one of the things you need to do is constantly be looking at the ROI on your contracts. And it's a fallacy to say that you can't renegotiate a contract. At SSI, we had a lot of success going back to the customer partners and revisiting the opportunities there, and by telling the story. So going back to 1 second here.
Yeah.
So going back to the partner, to the customer, and explaining to them that, at this margin and executing this contract in this manner, wasn't healthy for us, and to be a sustainable long-term partner, we needed to renegotiate. And in the case of an ice cream partner, we were able to pick up about 2 points on the margin, which was very helpful to us. In another case, we were able to bring a national CPG company back to the table and increase our rates so that we were actually making positive cash flow on that business. But again, it's being able to tell the story. So rate and volume can always be managed if you just take away that assumption that you can't renegotiate the contract. You should always feel that there's always that option. Another thing you can do in terms of volume is look outside your normal channels. It's a bit of I don't know if you're familiar with what they call the blue ocean strategy,
Mhm.
but it's where you really start to think about not just how to, what within your market can you go after, but what is not in your market? How do you expand your market to find other opportunities there? And so those are some of the things that we look at to make the most of um, the ways that you can manage your volume in a limited structure. Dairy in particular is a very limited market, but if you can start to apply blue ocean techniques, you can start to find some ways that you can expand that. And it might be maybe Greek yogurt. You've seen in the East Coast, you will see a lot of uh, wine ice cream. We don't see it so much here in California, ironically, but by people taking very innovative approaches to their products, they're able to grow the market opportunities and take their share from that.
Yeah, that's really smart. And when you're working with a contract, a lot of times, if we don't revisit the contracts, because a lot of the contracts have expiration dates on them, right? Like this is
Mm-hmm.
a contract, a 1 year contract, and that contract may have been in place for 8 years, 10 years, and there's been no rate adjustments. There's been no increase for inflation or
Mm-hmm.
cost of labor or cost of supplies. So you might be taking a bath, you might be actually losing money on certain contracts, right? Um,
Oh yeah. Mm-hmm.
yeah. So how do you, as a CEO, like give me an idea of a size of a company that, you recently worked with, advised, or came into this role. Give me an idea about the size. How many people, how many, what kind of dollars?
So we're talking about sales of about 150 million annual,
Mhm.
low margin about 2 to 3% at the bottom line. Um, so operating income and pop headcount of about 300 people. They were using a rebate structure on their contracts. The language was written very loose, and as a result, when they interpreted the rebate, the the salesperson liked to take the rebate check to the customer because they got a lot of kudos, right? And that's makes the salesperson, not all of them, but it makes a lot of them feel very good about that. The customer, they liked it because they were getting their rebate back to case zero. And they were interpreting case zero not at the case zero of that tier where that new rebate structure kicked in, not as case zero at maybe the beginning of the year, but case zero back to the very first case that they had ever produced.
Wow.
And so with that rebate check on this particular customer was starting to be $250,000 when I walked in. And they weren't generating $250,000 worth of EBITDA when we did our profitability analysis. So one of the things that we did, and it took us a bit of time to move all of this, was we took all of our contract structures for this business and we laid them out into just a nice little matrix. Again, not high tech approach it at all. There are tools now that you can use for it, especially the AI that can extract all that data. But just using Excel, what are your key functions, and then understanding what your pricing matrices are and what the kickers are, and understanding the language. One of the things also we did in that is that we shifted who's creating the contract. The approach had been before we arrived was that the salespeople would say, "Well, customer X, you give me what you want the contract to be, and then we'll work with that." Well, of course, I'm going to have a contract that favors me, right, with the terms and conditions. Well, we had, there were about 20 different customers and with contracts, and they're all being interpreted differently, and they all had different ways of executing. That
Yeah.
was an administrative nightmare for the back office. That was an administrative nightmare for the finance team. Trying to do a customer profitability analysis was very challenging. Trying to do a SKU analysis was challenging. So what we did also as part of that process was shift that, and we say, this is our contract, and this is how we approach the co-pack business. And then we negotiate from our starting point, and just that shift of the paradigm helped us then to standardize and take control of the contract governance piece of the business.
Yeah. This We're not comparing apples to apples here, but here's an example.
Yeah.
I take my kids garage sailing, and we,
Hmm.
I want my kids to learn how to sell, how to buy,
Hmm.
how to communicate with people. If they could look up and have a conversation with someone and not be on a phone or a tablet or something like that, that's what I'm trying to teach my kids. So we could go to a yard sale, not comparing apples to apples because you're talking hundreds of,
Hmm.
we're talking a couple, bucks here. But if you could say, how much is that? They name a price. Now you're trying to negotiate down from their price or whatever it is. Or you could say, hey, I'll give you $2 from that. Now they have to fight their way up to 20, right? So
Exactly.
it's the positioning of the initial framing of the value of the product or service, right?
Yeah, and it's that whole concept, and I think a lot of times we lose the art of haggling, and the fact that you're teaching your kids how to haggle is tremendous. We lose that art of haggle, and we like the fact that you can go to a store and buy something for a fixed price, but even at fruit stands here in the Central Valley, you can go and you can haggle a price just because it says something on the bin. Sometimes if you offer them, it's the end of the day, that it might be the end of the season, you can haggle the prices. What people want is to cover their basic costs.
Yeah.
And so understanding that pricing architecture, understanding your cost structure, understanding where your starting point is so critical. But if you don't know the salespeople, when I had walked in there, they hadn't seen a full P&L, so they didn't know truly what their gross margin was or their operating profit was on a line or a piece of equipment. So the fact that they were negotiating prices without having that full scope, one of the first things I did is say, I'm not signing any contract unless your plant accountant has signed off on this, and they've provided me with a P&L pro forma that I can look at and feel good about.
Yeah.
And so those are some approaches that you can take. But yeah, it is again shifting that paradigm and then managing to it. And it is a process. It's not personal. It's a process. And if you trust that process, it will get you to where you need to be.
Yeah. We process is one of the things, if we look at the 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 life cycle of a business, right? From idea, hey, I
Hmm.
got an idea in my garage to, IPO and public and enterprise. And if we look at that life cycle, process, especially on the growth side, is so valuable. You came in and you looked at the different processes involved. When looking at a company, whether you're going to get involved or not, what are some of the processes that you think provide the most value to be created or that could cause the most pain if not created well?
Uh, I'm going to start with P&L management, right? And the P&L, if not done right or understood right or communicated right, um, it, just everything flows from that, right? And we're all compensated based on the P&L, so it's a fair place to start. When I come into it as a leadership, and I'm looking at my P&L, I always like to know, well, how does this number? Okay, February results are great. We blew the profit. Well, if we pull out the non-operational items, what did it look like?
Mhm.
How does this profit look like February of last year, a year over year number? How does this number look like on a rolling, say, 13 months? How's our trend in our trajectory? So I want to know within the context, what is that number? I don't want to just celebrate, hey, we had a great February, because March could be bad. If we don't understand, how does this fit within the context of the broader business? So I always start with the P&L and the context. And sometimes that's easy to do and sometimes it's not. You know, the Superstore, with that turnaround, it was difficult because we didn't have clear lines of sight into the detail. And there were some accounts, I remember inventory valuation, that what you would assume inventory valuation was and how it acted as an account were contrary. But because the people who had worked with that account for the past 30 years, that was how it acted, they had no reason to question it. And when I came in and I said, well, how come your inventory adjustments are positive every month? And you expect it to be positive. That inventory adjustments should flip on themselves,
Mm.
because that's just what you're doing. It's a timing adjustment account. And you think I would have, it was blasphemy, but by the time we closed the business, we had it understood that that account, while it said inventory adjustment, that account had actually been programmed for taking kind of excess adjustments off of a rebate account, so that both accounts looked kind of, they tried to keep them both kind of normalized. And that's not what an inventory adjustment is. So in the course, though, over the years, had they understood that what an inventory adjustment is, and then they had studied that, they would have been able to maybe manage loss better in terms of the distribution side of the business, or even on the manufacturing side, understand where they were having their losses with the dairy products. So those are just some of the things that I think about when I look at my P&L, is understanding it within the context, not with just the standalone period.
Yeah. Now, my background, I came from digging ditches and swinging hammers on a construction site.
Mhm.
And this, recent, had to start learning the world of investment banking. I had to dig deep into P&Ls. So for people like me who maybe don't have a background in finance or C-suite leadership, P&L is the profit and loss statement, and it kind of gives a pulse on the company of how well this company is doing and where it's doing well or maybe not doing well. Profit and
Mhm.
loss statement. Um, you talk about educating the salespeople. So maybe even people like me who are, middle management or maybe even lower, you show them how their role affects the P&L because they get paid based on their P&L. Kind of explain that process as a leader, educating your employees to understand where does our money come from?
Yeah. So to help that discussion, one of the things that we were doing, well, I've done it at every company, is for the financial statements, ensuring that my team is sitting down with all the relevant managers,
Mm.
and every month going through the results in that P&L format and understanding what's driving those variances. And part of that discussion then, when we're reviewing as a C-suite team, is to talk about how we can impact numbers. So for example, if we're looking at a P&L, I always like to ask when I walk into an organization, to a manager, well, labor is what percent of your operating expenses? Now they should have an idea what that number is. I also like to ask what portion is depreciation, and then have discussions like, can depreciation is a non-cash expense. What does that mean? And then, even though it's non-cash, how does that affect you from a reporting perspective? Separate from how it affects me from an overall EBITDA perspective. So I try to have those discussions and focus on an account or an area of their profit and loss statement each discussion, each time we do a business review, and ask the questions around that. So it's kind of a stair step and build upon it. To give another example and kind of keep it simple here, is there was early on, I was teaching a graduate level accounting class for non-accountants, and it was in a master's program at University of Phoenix. And I had an exercise in there that I would do for students, that I walked them through the start of the class over 6 weeks with a lemonade stand. And we started off at the very beginning with the lemonade stand of, you're selling that glass of lemonade. Someone has provided you with the product and you're selling it. You bought it, for a certain, X cents per cup, and you're selling it for X cents per cup and you're making a profit. And then we started building inventory the next week. And then we started taking on a little bit of debt because we had to pay someone. We had some capital investments, so we had the depreciation. So just taking that lemonade stand example and adding elements of the financial statements around it. By the time we were through the 6 weeks, that lemonade stand that is on the corner now all of a sudden has a full P&L. It has a balance sheet and it has a cash flow statement. But by doing that using something that everyone understands, the child's lemonade stand,
Hmm.
you're able to back into that that allegory.
Yeah. There's a there was a book that I bought a while ago to try to learn a little bit more about the financial statements, and it was about the lemonade stand. Were you using,
Oh,
did you create this? Like, were you the author of
you
it?
know, I did not create this, but I'm sure I had heard it somewhere, maybe in a faculty training, or someone else had shared an idea, and it was easy to just adapt and share and carry forward, because it is very easy to teach someone that,
Yeah.
and it's something that we can all identify, because like you, I grew up on a farm, right? I didn't have, my mom was a teacher, my dad was a farmer, no one in business in my life. And I ended up in business because I was graduating with a bachelor's degree from a liberal arts college, and my bachelor's was going to be in literature. And there wasn't a big market for people who studied Milton and Chaucer and could play Renaissance guitar. And gigging at the local coffee shop, was not going to make ends meet. And my roommate said, come on down and take the GMAT. Not knowing what the GMAT was, I didn't need to pre-register. I didn't have anything else to do. I went and did that, and so that was kind of the beginning of my ending up the following year or following semester enrolled still at Santa Clara, but in their agribusiness program, because I was an Aggie, and it was a subgroup of their MBA program. So I earned my MBA through Santa Clara, and then went on to my business in life in business. And if you had asked me when I started college if that would happen, absolutely no way, because my worst math class was math without fear for English majors, and now I do math every day.
Yeah.
So we all have a journey there, but the lemonade stand is something easy to explain, um, and just try to keep it simple, because it is easy to make financials very overwhelming. I remember when I had stepped into one company as a director of FP&A, they had this Excel, this plethora of Excel spreadsheets that just created this very complex forecast process, and it took probably a day or two to generate. And I could just look at that and say, well, if you just kind of trend this and trend that, and these are going to be your big drivers, you don't need to forecast every account. Keep it simple, back of the envelope. You'll get there, and you'll get to close to the number that you need. And I always try to keep that keep it simple, and complexity will come naturally, and you manage it as it comes through. Um, but if you're doing that, you can keep to the truth and authenticity as quickly as and easily as possible with your numbers. So, but I do like to start with the P&L. So back to the original question. So,
Yeah. So when it comes to the kind of work that you do as an advisor, interim CEO, sometimes just a takeover, coming in to rescue someone, what kind of companies are a good fit for you? Like, what kind of companies do you like working with? What size? What scope? Kind of give an idea of what the perfect opportunity is for you.
for me, I've Superstores has been the largest. It was at 1.2 billion. Um, that for me, that sweet spot where I I believe I give the greatest value is going to be that, if 50 million on a growth, something that's scaling to, maybe 300 or 400 million. Um, that size organization is something where I can take my FP&A background and take my accounting background and use that to leverage my CEO advisory hat and come in. So I can look at the business, I can understand processes very quickly, and then when I have the financial, I can do that sniff test, right? That we
Mhm.
all learn to do. Does that smell right? Does that, is someone telling me something that doesn't make sense? You start to be able to have those discussions, and it's that organization, that level of business. I've found that those much smaller businesses, and I've been in some recently that have been more of the $1 to $10 million range, and they've been very family owned, family led, kind of more legacy type businesses handed down through the family. Those are a little more challenging for
Mhm.
me in that there's so much personal legacy held into that they're not able to let go and allow it to be professionalized.
Mhm.
And in one case, we were working on the turnaround, and we had identified what we needed to do to build the pipeline. We had a strategic plan set up, um, but we needed a capital investment, and it wasn't significant. It was like $2 million for that initial capital investment to kickstart us so that we could get the steel that we needed so that we could generate the equipment and start building the orders. Because on an order, we'd get 50% up front, and it was a little bit more than that we needed to manifest it. And the owner at the end of the day didn't want to kick in 2 million, whether the owner had it or not. They didn't want to go to the bank and ask for it. So, for $2 million, the business then wasn't able to turn around and move
Mm.
forward. So now today it's just doing manufacturing custom parts for its equipment in the field that is slowly um, falling out of service. So it's now a dying business. They had so many options. We were proposing either turnaround or stabilize and sell. And either the stabilize and sell would have taken a little bit of capital too, but not as much. But just to let it wither, that's a strategy, and we see a lot of businesses do that. Family businesses, especially, that they'll allow it to just kind of reach a point and then they shut the door.
Mm.
Um, so it's a strategy.
Yeah. My my heart hurts for a company that doesn't want that to happen, but it happens because maybe they don't have the capital to infuse, they don't have the right people, they don't have the right teams,
Mhm,
or they don't have the knowledge. We're in a time period where you talk about family legacy businesses. We're in a time period,
mhm,
they call it the silver tsunami, the greatest
mhm.
transfer of wealth, that these people built this business and now maybe their kids don't want it. Maybe, there's not a strategic buyer. Maybe they don't have a business to sell. Maybe it's just a job. So I see that happening. My heart definitely goes out for them.
Yeah.
For business owners who do want to build that legacy, to build
Mhm.
something that goes beyond just a tight knit family business to maybe something bigger that maybe their grandkids could participate in it one day. What advice do you have from, first time founder, family business to
Mhm.
transition into something that you describe? That's a hard
Yeah,
question.
I have for two pieces of advice. One is know your banker, build your banking relationships.
Yeah.
Um, and at, in my experience, it may not be your primary banker. There may be other people who do some kind of equipment lease back or just have additional capital to invest. But know the banking community and not be afraid to talk to the banking community, build those relationships, because you might find that there is some capital out there that might be suitable for you and on terms that you and your family can live with. Leverage is not a bad thing. It'll need to be managed, and someone will need to be keeping an eye on that leverage and then making sure that you're using the funds correctly.
Mhm.
as intended, and you're accounting for it and keep the visibility there. But don't be afraid of banking, and don't be afraid of leverage or debt. That's the first thing. The second thing is, and this one, it happened about, I'm going to say maybe 30 years ago. So I don't want that to date me, but I look at companies like, let's go to the wine industry. So like Franzia Wines
Okay.
or Gallo Winery
Yep, I know
or
Gallo.
Delicato. Those are all three in my vicinity. Matter of fact, I went to school with all those kids, and we're all in the same Italian community. Um, and one of the things that they're my generation, that the parents had all done, is they stopped and looked at the family and said, just because you're carrying that name or you're part of the family doesn't mean you belong in the business.
Ooh.
And they brought in consultants to assess the next generation, to see who really had an aptitude for the business versus who really did, who just wanted a share, right, to get their dividend.
Mhm.
And to help them then set up that business structure so that it could carry on. And so today, that's why you see, Chris and Delicato is running the Delicato Vineyards. Um, you see, the the Franzia family, they've spun off into some of their own. They're into a lot of uh, boutique wines and all that generation. And Gallows, you now have G3, which is a whole generation. And each generation now, as it comes through, those who want to be in the business, they're spinning off and they're taking a piece of it. G3 was in, I want to say, the glass manufacturing, but don't quote me on that. So they're all taking a very business approach, but they had to make that investment
Mhm.
in consultants, and trusting a process to come through and say objectively, and then once they had that plan, come through with that plan and act on it, and stick to it. And when I say stick to it, not a hard stick, but because I don't believe any plan is ever a hard stick, but you have to have a plan to know where you're going, and how you're going to get there. And sometimes the plan needs to be adjusted. So that's what I'm trying to communicate with that. But I think that those are the two things. One is building a relationship with the banking community so that you can understand what your options are, what they mean to you, so that you can best assess if there's capital there that you may not have immediate access to, but you'll get such an ROI on your project or investment that if you're adverse to debt, you can work your way out of it. And, it's those things that by building that relationship, that banker can help you develop there.
Yeah. Fantastic. Karen, for people who would love to connect with you, follow your work, maybe have a conversation, what's a good place for them to reach out to you?
LinkedIn is the best place to reach me. I try to stay very visible and current out there. Matter of fact, when you post the podcast, I'll have it on my profile. I'm very excited about that. Um, but I do try to stay current in terms of discussions around anything transformational leadership, um, dealing with people first activities. I'm really into AI right now because I just see that as so much untapped potential. I'm
Mhm.
been doing a lot of advisory work with startups in San Francisco, Footnote, who is using AI and developing technology around um, freight forwarding activities. Raw Copper, who's using AI to develop an Excel add-in that allows you to really go grab mass amounts of data very quickly. Um, these are, two examples of some startups that I've just been, by being a higher profile on LinkedIn right now, I have this generation reaching out to me and just picking my brain about what have you seen, where are the pain points, you know, how do you see it applied in different industries, and how am I on the right track, and encouraging people. And I really like that aspect of helping people build and grow and develop. And I like to be in those positions of helping doing that. So
Yeah.
um,
That's fantastic. Um, I'll put your link in the show notes below. Um, Karen, thanks for coming on the show and sharing your knowledge and wisdom and encouragement to all the people out there in listening in. Follow her work there. She posts amazing stuff out on her LinkedIn. And for fellow deal makers, if you have a deal that you'd like to talk about or a structure or some insights into the industry, head on over to thedealscout.com, fill out a quick form, and maybe we'll get you on the show next. Till then, we'll talk to you all on the next episode. See you, everybody.
Thank you.